The headline exploded across social media, igniting a frenzy of speculation and anxiety among investors, analysts, and everyday people alike. China strikes at U.S. banks with massive 150% gold tariff shock. The words seemed almost surreal, echoing across every major news outlet and financial blog. On Wall Street, traders stared at plunging numbers, their faces etched with concern as panic spread through the trading floor. The markets, already jittery from months of global uncertainty, reacted instantly. Banking executives scrambled to assess the potential fallout, fearing an unprecedented economic attack that could destabilize not just their institutions, but the global financial system itself. The story painted a vivid picture of economic warfare. China, the world's second-largest economy, seemingly targeting the very heart of American finance with a single dramatic move. For many, it wasn't just about numbers on a screen, it felt personal, a direct challenge to the stability and security of the financial world they depended on. The rumor mill spun furiously. Was this the beginning of a new Cold War, one fought not with missiles but with tariffs, trade restrictions, and financial leverage? The idea of a 150% gold tariff was staggering. Gold, long considered a safe haven in times of crisis, suddenly became a symbol of economic hostility, not just competition. Such a move would have sent shockwaves through global markets, affecting everything from jewelry prices to central bank reserves. The headline spread like wildfire, feeding on deep-seated anxieties about U.S. China tensions that had been simmering for years, trade wars, technology bans, and diplomatic standoffs. But was it true? Did Beijing really weaponize gold against American banks? Or was this just another chapter in a long saga of economic rivalry and misinformation? The drama was compelling, almost cinematic, but our job is to find the truth, to look past the headlines and the hype, and to understand what's really happening beneath the surface. We need to look past sensationalism and examine the evidence, official statements, trade data, and the actual mechanics of international gold markets. Viral headlines can create a sense of crisis, but facts matter more. In the world of finance, perception can move markets, but only reality can sustain them. So, let's dig deeper. Was this a real strike, an intentional act of financial aggression, or just digital age fiction, amplified by the echo chambers of social media and 24-hour news cycles? The stakes are too high to be guided by rumors. Billions of dollars, international relations, and the livelihoods of millions hang in the balance. Let's separate fact from fear, and rumor from reality. What really happened behind the headline? Who benefits from the panic, and who stands to lose? The truth is rarely as dramatic as the story, but it's always more important, especially when the world is watching. So let's get to the bottom of it, together. Did China actually impose a 150% gold tariff targeting U.S. banks? The answer is a clear no. No credible news source, Reuters, Bloomberg, Wall Street Journal, reported such a move. If it were real, it would have dominated global headlines. The silence from reputable outlets speaks volumes. So where did this story come from? Speculative YouTube videos and unverified social media posts. These platforms thrive on shock and outrage, not accuracy. The headline was engineered to provoke, not inform. It's digital sensationalism at its finest. There's a world of difference between a fact-checked report and a viral rumor. The 150% gold tariff story is a textbook case of fiction dressed as fact. It preyed on fears of economic instability and U.S. China conflict. When fiction masquerades as fact, it can cause panic and real financial harm. That's why we must question what we see online, especially when it's designed to scare us. The gold tariff was a phantom threat, born from speculation, not substance. Vigilance is our best defense. Let's focus on the facts. April 2025 was a time of real U.S.-China economic conflict. The U.S. hiked tariffs on Chinese goods, some up to 145%. China retaliated with its own tariffs up to 125%, on a broad range of American imports. But here's the key. These tariffs targeted general goods, not gold. There was no targeted strike on U.S. banks. The viral story twisted a real event, a massive tariff escalation, into a fake one. This is classic disinformation grounding a lie in a sliver of truth. The reality was a tit-for-tat trade war, not financial warfare. A general tariff is a blunt tool, not a surgical attack. The rumor distorted the subject and the target. Understanding this difference is crucial. The real story is about escalating trade tensions, not a gold tariff. Don't let a viral headline rewrite history. Critical thinking is your best shield. While the gold tariff was fiction, the trade war's impact on gold was real. Escalating U.S. China tensions injected massive uncertainty into global markets. Investors fled to gold, a timeless safe haven. Gold prices soared, smashing records above $3,200 an ounce. The surge wasn't about a fake tariff, but real fear over economic stability. Chinese demand for gold skyrocketed, with local premiums spiking. Citizens, facing a weakening yuan and trade turmoil, rushed to buy gold. The government's actions fueled uncertainty, the people's response fueled demand. The trade war didn't target gold, but it made gold more valuable than ever. Markets are unpredictable and interconnected. The real driver was fear, not fiction. Gold became the barometer of global anxiety. The lesson, real events, not rumors, move markets. To understand gold's rise, follow the big money, central banks. The People's Bank of China, PBOC, was on a historic gold buying spree even before the tariff war. This was strategic de-dollarization. By buying gold, China reduced its reliance on the US dollar and shielded itself from American sanctions. The trade war accelerated this push. The PBOC's massive purchases set a floor under gold prices and signaled confidence in gold's value. This official buying, combined with private investor panic, propelled gold to new heights. The real story isn't a fake tariff, it's a global financial shift. China's gold accumulation is a long-term play to challenge dollar dominance. The trade war was just an accelerant. The PBOC's actions matter more than any headline. Gold's rise is about strategy, not scandal. Watch what central banks do, not what rumors say. Let's separate fact from fiction. Fact: the US and China waged a fierce trade war in 2025, imposing massive tariffs on general goods. Fact: this uncertainty drove gold to record highs. Fact: the People's Bank of China was a major gold buyer, diversifying away from the dollar. Fiction: China never imposed a 150% gold tariff targeting US banks. That claim was pure disinformation, born online. Sensational headlines hijack emotions and bypass critical thinking. In a world of viral rumors, skepticism is essential. Always check sources, don't let fiction drive your decisions. The real danger is the erosion of trust in rational debate. Next time a headline shocks you, pause and verify. The truth is rarely viral, but it's always worth finding. Your peace of mind and your wallet depend on it. As the rumor of China's alleged 150% gold tariff spread, the world took notice. Major economies like the United States, the European Union, and Japan scrambled to assess the potential impact on their own markets. Central bankers convened emergency meetings, not to address real policy, but to calm investors spooked by the headlines. Global financial institutions, from the IMF to the World Bank, issued clarifying statements. They reminded markets that no official tariff had been confirmed and urged caution against knee-jerk reactions. Still, the uncertainty rippled through trading floors, gold prices spiked even higher, and stock markets dipped as investors hedged against perceived risk. Some governments quietly reviewed their own gold reserves and trade policies, wary of getting caught in the crossfire of economic misinformation. Meanwhile, regulators in major economies began discussing new strategies to combat market manipulation fueled by viral rumors. Ultimately, the international response underscored a critical lesson. In an interconnected world, even false reports can shape real outcomes. The scramble to react, clarify, and stabilize revealed just how vulnerable the global economy is to the speed of modern misinformation, and how vital it is for leaders and investors alike to separate fact from fiction before making decisions that move markets. The gold tariff controversy of April 2025 may have been rooted in misinformation, but its effects reached far beyond a single news cycle. In the aftermath, experts warned that the incident could mark a turning point in how global trade and monetary policy are managed. Analysts predict that central banks and regulators will invest more heavily in real-time monitoring of financial news and social media, aiming to detect and counteract rumors before they spiral into market chaos. Some countries are already discussing the creation of international task forces dedicated to combating economic misinformation, a kind of digital firewall for global finance. Trade policy, too, may become more cautious. Governments are likely to build in new safeguards to protect their economies from sudden, rumor-driven shocks. This could mean more frequent reviews of strategic reserves, tighter controls on market disclosures, and closer coordination between nations to ensure that policy changes are clearly communicated and verified. Looking ahead, experts believe that similar events could become more common as information travels faster and markets grow increasingly interconnected. The future of international finance may depend on how quickly institutions can adapt to this new reality, balancing transparency, stability, and the need to respond decisively to both real and perceived threats. In the end, the Great Gold Tariff Scare serves as a reminder. In the digital age, the boundary between fact and fiction is thinner than ever, and the stakes for getting it right have never been higher.